In tariff news, President Trump announced a big win, a trade deal with Japan, the first deal with a major country. All three wireless companies reported. T-Mobile has a story, and a relatively simple one. General Motors, not a great quarter. Tesla's numbers were anticipated to be bad, and they were still bad. The meme short attack is trying to make a comeback. Getting involved with these meme stocks can be harmful to your health. Predicting how stocks react to earnings is a perilous exercise. So let's get started. Hi, this is Steve Eisman, and welcome to another edition of the Weekly Wrap. First, the stats. For the week ended July 25th, the S&P was up around 1.5%, and NASDAQ was up 1.1%. For the year, the S&P is now up over 9%, and NASDAQ close to 10%. Both indices are at all-time highs. In tariff news, President Trump announced a big win, a trade deal with Japan, the first deal with a major country. There were many details, but the tariff on Japanese goods will now be only 15% versus the threatened 25%. Japan also agreed to a $550 billion fund to make investments in the U.S. The deadline for everybody else remains August 1, and earnings season continues. Now, last week, earnings season began with 38 companies reporting, many of them financials. This week, 113 companies reported, and even more will report next week. Quite a data dump. Obviously, I'm not going to go through all 113 companies, just the ones I think are important or interesting. So let's get started. First up, all three wireless companies reported: Verizon, AT&T, and T-Mobile. Verizon and AT&T results were fine. T-Mobile's results were great. More on that later. Verizon and AT&T, for historical purposes, used to be important companies, the 1990s to be exact. Both Verizon and AT&T are 180 to 200 billion market cap companies, but their stock prices, despite the nice rally they have had this year, are below where they were in the year 2000. I'll repeat that. They are below where they were in the year 2000. Both have not been viewed as growth companies for a very long time. They are viewed as safety staple stocks you buy only when you're worried about a potential recession. AT&T's PE multiple is a 12 to 13 times, and Verizon is a lowly 9 times. But T-Mobile's multiple is 22 times, and back to being near a multi-decade high. How is this possible? How can three companies all exist in the same industry, and one, T-Mobile, is viewed as a growth story, and Verizon and AT&T are treated as non-growth staples? That's because T-Mobile has a story, and a relatively simple one. T-Mobile has the best wireless network in the US, and it is the low-cost provider, and it passes on those lower costs to its consumers. As a result, it keeps taking market share from AT&T and Verizon. That has been the story in wireless for years, and that's what T-Mobile showed when it reported this week. It beat on earnings, it beat on revenue, and it beat on new subscribers, and it raised guidance. Now, since I just talked about wireless companies, I'm going to talk to a related topic: cable companies, specifically Charter Communications, which is merging with Cox Communications. Charter reported earnings per share of $9.18 versus $8.49 last year, but a miss versus the estimate of $9.82. Most importantly, it lost 111,000 internet customers versus an estimate of a loss of 73,250. The stock was down 15% on Friday. So what's going on here? If you look at a chart, Charter reached a peak of slightly over $800 per share in 2021. Now that was during COVID, when everyone was hooking up to the internet through companies like Charter, to its current stock price of $320. Quite a decline, but there is a lot more going on here than just a pull forward of internet demand during COVID. If you go back about 10 years, companies like Charter and Comcast were steady Eddie growth companies. They had two major products: cable and internet access. Now, with the growth in Netflix and the resulting cord cutting, cable became a negative growth business, but internet access kept climbing. And then sometime after 2020, things really started to change. If you go back 10 years, companies like Charter and Comcast were steady Eddie growth companies. They had two major products, cable and internet access. With the growth in Netflix and the resulting cord cutting, cable became a negative growth business, but internet access kept climbing. And then, sometime after 2020, things really started to change. Wireless companies like Verizon were making inroads into the home in both cable and internet access. At the same time, cable companies began to get into the wireless business. Everyone was trying to eat each other's businesses. And because of all this competition, Charter is no longer a growth company at all and faces intense competition on all fronts. And that's what Friday's earnings results all pointed to and were all about. Moving on. Two home builders reported this week, D.H. Horton and Pulte Home. The home builders have been underperforming since mid-2024. Interest rates have been too high, and the builders have been increasingly using incentives to push home sales, which has hurt their margins. On Tuesday, DHI, the group bellwether, rose 13% after it beat expectations. Pulte had similar type results. But don't get carried away. It's not like fundamentals all of a sudden got a lot better. They did not. So, for example, Horton lowered the top end of its full-year guidance for closings to 85,000 from 87,000. Given the negative sentiment on the builders, I think the group rallied because many were expecting far worse results. Like I said last week, predicting how stocks react to earnings is a perilous exercise. Equifax, one of the three credit bureaus. Company has several great businesses, but is over-indexed to mortgage volume, and that is why the stock is at levels seen in 2021. It is and always has been an expensive stock with a 2025 PE of 32 times. The company reported adjusted EPS of $2 versus $1.82 last year, and versus the forecast of $1.92. So far, so good. But the company gave soft earnings and revenue guidance for the second half of the year, and the stock slumped 9%. General Motors, not a great quarter. The company earned $2.53 per share, which was above the $2.33 forecast, but below the $3.06 it made last year. GM profits suffered from some higher warranty costs and a buildup in electronic vehicle inventory, and that business is about to lose subsidies from the president's recent budget bill. Also, General Motors said it suffered a $1.1 billion hit to its profits from tariffs and said it has no plans for any near-term fixes to get back to pre-tariff profitability. The stock was down over 7% that day. Enphase, a solar company selling systems to consumers to put on their roofs. On my podcast this week, I interviewed Lakshmi Ganapathy of Unicus Research, who publishes research on shorting stocks. Enphase is one of her short recommendations, and we discussed it on my podcast. And the company reported this week. This solar company was once a high-flying stock, but from a peak of 340 in 2022, I repeat, 340 in 2022, the stock is now 35. Why? A couple of reasons. The first major downleg in 2023 was from the fact that it costs about $30,000 to put a solar system on your roof, which is what Enphase manufactures. Now, when rates were zero during COVID, that was an enticing proposition. But with rates much higher, volumes have collapsed. Changes in regulation in California hurt as well. But the latest leg down, and I mean for the last several months, is due to the reduction and elimination of federal solar subsidies in the latest budget bill. Now, after the company reported, I reached out to Lakshmi for her thoughts, and she pointed out a few things. Revenue for the quarter fell to $363 million, nearly half of the $711 million posted in the same quarter last year. Quite a fall. And operating cash flow of $80 million was down from $190 million last year. Also, the company expects $330 million to $370 million in September quarterly sales, but the consensus is for $372 million. The stock was down 14% on Wednesday. GE Vernova, symbol GEV. Last week, GE Aviation reported. This week, GE Vernova. GE Vernova manufactures gas turbines for utilities and does other things as well. This is not a well-known company, but a very important one. Partially because of the growth in AI, the demand for electricity in the US is growing fast and faster. Electrical power is the binding constraint on AI. Given the elimination of subsidies for solar, the importance of gas turbines for utilities just went up a lot. GEV reported nice numbers, beating most metrics. Orders were also quite strong. The only negative here is that the valuation is quite rich. 86 times earnings per share for 2025 and 53 times for 2026. Why so rich? Scarcity value. There are only two major companies in the world that make gas turbines, GE and Siemens. GEV was up almost 15% on Wednesday. Moody's. Moody's and S&P have incredible business models. I mean, really incredible. They run a duopoly with huge moats. But even duopolies are not immune to market forces. Moody's reported good numbers and maintained guidance, but the market volatility is hurting parts of its business. They reported adjusted EPS of $3.56 versus $3.38 last year and versus $3.38, which was the estimate. So people were expecting flat earnings. So the numbers were good. But I would just point out that the market volatility is definitely hurting fixed income volume, which is what Moody's rates and is an important part of its business. But Moody's rallied with the market despite the earnings being a sort of a non-event. S&P reports next week. Amphenol, a tech company that most people don't talk about much. Amphenol makes advanced interconnect systems. It is a beneficiary of the AI revolution, as its products are needed to create AI systems. The company reported 81 cents per share versus 44 cents per share, and versus the estimate at only 67 cents per share. Quite a blowout. Now, usually Amphenol beats, but by just a touch. But revenue beat estimates, earnings beats estimates, and the company raised revenue and EPS guidance. Amphenol is an example of where the AI story is reaching, and the stock rallied this week from 97 to 105. Fiserv, part of the payment space. Payment space is a very difficult one. Competition is intense. Everyone is going after everyone else's business. Now, when I invest in the space, I only focus on Visa and MasterCard, whose competitive positions are, I think, still unassailable. Fiserv reported this week. Numbers were okay, but it lowered its forecast for the year to the low end of the range. If you dig down in the results, it's pretty clear that Fiserv continues to lose market share in the payment space. The market was not happy, and the stock was down 14%. Google. Amongst the Magnificent Seven, Google has lagged. Apple has been worse, and Tesla has been the worst of the seven. But Google has lagged and is up only 2% this year. Why? Everyone is worried about AI's impact on search, which is Google's biggest business. Now, Google has other big businesses, YouTube and cloud services, and they are doing well. But everyone fears that AI search will replace Google search, and there goes Google's search monopoly. And those fears are also reflected in its multiple, which is only 19 times the 2025 EPS consensus estimate. Now, for a major tech company with an annual EPS growth rate above 20%, that is a lowly, lowly number. And yet, Google reported great numbers. Search revenue growth was up 12%, YouTube revenue growth was up 13%, and cloud services revenue growth actually accelerated to 32%. So very impressive. So normally, with performance like that, the stock should have been up a lot on Thursday, but it was up only 1%. Why? Because everyone is still worried about AI search, and it will be quite a while before we know how AI search shakes out. Chipotle, best restaurant stock for a long time, but it reached a peak of almost 70 in mid-2024, and now it looks like a broken stock. The stock was down 14% on Thursday after reporting Wednesday night. Revenue and earnings were in line, but that was not the story. The story was that same-store sales growth was negative 4% versus plus 11% last year and versus an estimate of negative 3%. Now, same-store sales growth is the key metric in retail, and Chipotle's negative 4% is just plain bad. And has a very high multiple of 37 times earnings this year. This stock could continue to derate. Tesla, worst performing stock of the Magnificent Seven. Tesla's numbers were anticipated to be bad, and they were still bad. Earnings dropped 23% year over year, and total revenue declined by 12%. I'm going to say that again. Earnings dropped 23% year over year, and total revenue declined by 12%. The problems here are many. First, Tesla builds many of its cars in China and taught Chinese manufacturers how to build EV cars. So now, Chinese EV companies build better and cheaper EV cars than Tesla. And so Tesla is losing market share all over the world. Also, the new budget bill eliminates EV car subsidies, so that's going to hurt too. Musk is telling investors to be patient and seems to be betting Tesla's future on robo-taxi services and autonomous driving technology. But that's the future, and perhaps some investors are losing some patience. The stock was down 8% on Thursday and is down 24% this year, but it is still a cult stock. Any other company with Tesla's high multiple that produced bad results like this would have been down a lot more on Thursday. Blackstone. Generally, financials are viewed as cyclical companies. Sometimes there are growth subsectors. The payment sector was like that during COVID, but since then it's been a food fight for market share. But the alternative space, mostly private equity, has been a growth sector. And it might still be, but it's having some issues right now. Specifically, because of a multi-year weak IPO and M&A market, private equity companies have had trouble selling their companies, realizing those gains and giving that money back to their investors. There have been multiple stories of large investors like universities looking to sell their PE stakes. So it was of interest to see if any of that bad stuff was showing up in Blackstone's numbers when they reported. But numbers were strong. Earnings beat and were up 26% year over year. Fee-related performance was strong, and inflows looked good at $52 billion versus $39 billion last year. The private equity industry is definitely having issues, but Blackstone's numbers were still good. And that's all I have to say about earnings week. But I want to discuss a different topic. As many of you know, I've been long-term bullish for a while. I just think that the US economy is more dynamic than ever, and this is good for the long term. But this week, I saw the first sign of some market frothiness. The meme short attack is trying to make a comeback. Now, back in 2021, certain stocks attracted retail investors, companies with severely impaired business models, companies with very high short interests. Combine that with campaigns on social media, and you got tremendous short squeezes. Stocks like GameStop and AMC Theaters. At one point in 2021, for example, AMC got to as high as $80. But eventually, the meme stock craze died, and today AMC is $6. But maybe meme stocks are making a comeback. The latest meme stock is Opendoor. Symbol is open. Before discussing the stock, I just want to say that I have no position in it. This is just my opinion. I have no skin in this game. Open tries to make buying and selling homes more efficient by buying homes itself and then reselling them as quickly as possible. This is a difficult, balance sheet intensive business. Zillow tried it and abandoned it. In 2021, Open got as high as $35. My podcast guest, Lakshmi Ganapathy of Unicus Research, initiated coverage of Open in late February 2021 at $30 and closed her short in late 2022 at $1.26. Nice call. There is a hedge fund manager out there initiating a short squeeze on this still heavily shorted stock on social media, arguing that the stock, which about a weekend or so ago was less than $1, is worth right now $40 and could be worth eventually $80. Now, that's either gutsy, nuts, or just plain bad manipulative stuff. Anyway, he has rallied the stock from below $1 more than a week ago to $2.88 at the end of Tuesday. That's a social media short squeeze, and as far as I can tell, there is no new fundamental news out about Open. Yes, there is a new CEO, but that's been true for a while. So again, stock up a ton on no news, the memesters strike again. That's a sign of frothiness. But just to show this meme story has legs, on Wednesday morning, GoPro and Krispy Kreme were up 50% and 16% respectively that morning, although those gains did taper off during the day. Of course, we are talking about stocks below $5. These stock price surges were based on no fundamental news, but by a mix of social media buzz and short squeezes. Now, on Wednesday, open was down 20%, but on Thursday, open was up 10%. Getting involved with these meme stocks can be harmful to your health. But so far, this meme rally has not been all that impressive, with not much duration, but we will see. And that's the wrap. And now for the mailbag. As many of you remember, last week on the weekly wrap, I announced I was beginning treatment for breast cancer. I received hundreds of messages from viewers wishing me well. I can't tell you how much I appreciated every single message. So thank you to all of you. But I just want to flag one message which I thought was really funny. One viewer commented, quote, "I guess the moral of the story is to play squash with a good oncologist." To which my response is, amen. And here's a question from Andrew Latendry, who says, "I doubt this will be read wrong, just due to how quickly the video seems to be growing. However, if you do, I would love to request a video where you dive deep into the financial statements and how you were able to see the red flags that all other quote-unquote experts were just completely overlooking from back in the 2006-2008 period. We've all seen the movies, read the books, heard about the headlines, but myself, a blue-collar worker who is entirely self-taught about finance and the markets, has never seen a deep dive into what a master of accounting like yourself, flatterer, would be looking for. I'm not even convinced college courses would help all that much compared to someone like yourself diving deep into the topic and using real examples from that time era. I'm sure this would be an extremely long episode, but the value would be equivalent to that, and at some point, maybe even greater than that of Buffett's chairman letters. That's really quite flattering, which are some of the most insightful sources an investor could read. I hope this message makes its way to you, and thank you for these master classes you are giving us for free. Your health takes priority, of course, so good luck and best wishes to you. We all wish you a healthy and speedy recovery." A lovely letter, to which my response is, you're in luck. I have decided to expand this podcast into financial literacy, and I have already recorded two 2-hour lectures. The first one, which will probably land hopefully in a few weeks, is just financial literacy, various topics that I think are very important for investors. It's 2 hours, and we'll break it out and put it out over 2 parts. And then I also recorded a 2-hour lecture on the financial crisis, a real deep dive into its causes, its effects, and what's happened since. I'll be doing more of these financial literacy topics. And what I would ask for people who want to learn more is to send me an email at info@steveeisman.com about topics that they would like to learn about, and I will examine those issues very closely. And that's the wrap. Last Monday, I posted an interview with Lakshmi Ganapathy of Unicus Research. She publishes research on shorts, and we explored what makes a good short and what makes a bad one and lessons learned. This Monday, I will post an interview with Brad Safalo of PAA Research. Brad also publishes research on shorts, and we will explore similar topics. Hope you tune in. If you haven't already, please consider subscribing to our YouTube channel so you can receive these weekly wraps along with our podcasts and the financial literacy masterclasses, which we will be releasing soon. Subscribing is the best way to help the channel, and we greatly appreciate your support. Thanks for watching, and see you next week. This podcast is for informational purposes only and does not constitute investment advice. The host and guests may hold positions in stocks discussed. Opinions expressed are their own and not recommendations. Please do your own due diligence and consult a licensed financial advisor before making any investment decisions.